$687 million tied to its debt. A year ago, these numbers were effectively zero, proving that the market's complacency is starting to crack like a cheap smartphone screen. Gregory Peters from PGM Fixed Income put it perfectly when he asked if investors really want to be nakedly exposed to this hyperscaler phenomenon. Apparently, the answer is a resounding no, as the number of dealers quoting Alphabet credit default swaps, or CDS, jumped from 1 to 6 by the end of 2025. Even Amazon saw its dealer count nearly double in the same period. Watching big tech borrow this much is like watching a billionaire decide to live off credit cards just to see what happens. Why is this happening now? Activity really picked up in the fall of 2025 when the sheer scale of the debt requirements for these companies became impossible to ignore. We're looking at an environment where artificial intelligence investments are expected to cost more than $3 trillion. Much of that mountain of cash is going to be funded through debt, meaning the demand for hedging or protection is only going to grow. Morgan Stanley projects that borrowing by these hyperscalers will reach $400 billion this year alone, which is a massive jump from the $165 billion they borrowed in 2025. Alphabet itself mentioned that its capital expenditures could hit $185 billion this year just to keep the AI build-out alive. To put that in perspective, that's enough money to buy a small country, or at least enough to make their bondholders start checking the exits. And yet, the market's appetite for this debt is almost surreal. Alphabet recently had a $32 billion debt sale that drew orders for many times that amount within just 24 hours. But here is the kicker. They successfully sold 100-year bonds. Think about that for a second. They are selling century-long debt in an industry where a company can become completely obsolete in a decade. It's the financial